Welcome back to Intelligent Investment Today, the podcast concerned with all things value investment. In each episode, we consider a different topic from the investment landscape and consider how we can apply the teachings of the father of the craft, Benjamin Graham, to the problem at hand. In this episode, we should be taking a look at the interesting case of the Japanese stock market crash of the early 1990s. We'll be looking at the build-up to this event and considering why this particular crash was a particularly unusual one, given the fact that recovery did not take weeks, months, or even years, but only after several decades of economic stagnation and malaise. Finally, we will conclude if we could ever see a replay on other international stock markets, and if so, what hope has a value investor in spotting it beforehand. So let's get right down to it. As ever, sit back, strap in, and get ready to take on board another lesson in value investment as inspired by Benjamin Graham. Back in the late 1980s, Japan's economy was the envy of every industrialised nation. Off the back of an almost uninterrupted 45-year growth cycle that had begun in the ruins of their defeat in the Second World War. This cycle would culminate in the country going on to become the world's third largest economy, behind only the USA and the Soviet Union. The period that went on to be known as the Japanese economic miracle would propel the country from being the producers of a jumble of cheap junk towards manufacturers of technology of the highest end. The situation preceding the 1990s was reminiscent of what we would later go on to witness with China's own economic miracle. A slew of something similar products racing off production lines from Osaka to Yokohama, and whilst it ever so slightly heavy-handed might have found issues pertaining to rapid disassembly, as well as children's toys with razor-sharp edges, this proved not to be a problem for foreign consumers, because they were available at knockdown prices. But just as we're beginning to witness in China today, gradually at first, and then more rapidly, quality began to improve. The 1980s would go on to become Japan's culminating phase, when it came to the production of really quality high-end stuff. Whether that be automobiles, electronics, engineering or pharmaceuticals, suddenly Japan did it better than anyone else. All eyes were suddenly on the island nation and what they had achieved. Japan was in vogue and the country became a mecca for capitalists, with everyone wanting a piece of the action. And we began to witness the same old story from the same old playbook. All of a sudden, no price was too much to pay, and inevitably stock markets boomed. The increase in stock prices was only part of it, however. The change in the country's economic fortunes triggered a more general asset price bubble, with the price of land and property skyrocketing. The huge increases in property valuations did much to boost corporate balance sheets, further fueling stock price gains. But what we were seeing was beginning to look quite unsustainable. Caught up in the hype, nobody could see an end to the good times in sight. But by definition, every story must have an ending, and Japan's economic miracle came grinding to a sudden halt in the early 1990s. The Nikkei, the main Japanese stock index, peaked in December 1989 at almost 39,000 points. But by the end of August 1992, it had plunged by over 60%. But this was not the end of the story. Normally during financial crashes, you will see a quick or gradual recovery, and a couple years later, we were back where we started. But this was not to prove the case here. It would not be until 2003 that we would see the post-bubble low of around 8,000 points. That would be a drop of around 80% from its height some 13 years previous. But the period that would come to be known in Japan as the lost decade needed upgrading further still. It would not be until February 2024, some 24 years later, that the Nikkei would finally recover to its previous heights. The story of Japan's lost economic decades is a truly unique one in modern economics. But I guess the real question that we should be asking ourselves is, could we ever see the likes again someplace else in the world? A crash that doesn't sort itself out in quick order, but one that lingers on like a bad musical. The answer to me seems obvious enough. If it happened once, it can happen again. So I guess the question for the value investor is, can we be sure we would spot it if it did? I'm hopeful that the answer is yes. Would any one of us really have looked through the accounts of any Japanese company in the late 1980s and come to the conclusion that this is where the value lies? I don't think so. I think you would have struggled to find anything that remotely resembled a value proposition. But here is the thing. I feel the same way today about the US stock market, yet it still seems to attract value investors in their droves. What they are seeing is a mystery to me, as it probably is to them. I challenge you, my dear listener, to present to me a value case in any single US stock right now based upon a demonstrable financial showing. I don't think you'll be able to do it. A qualitative proposition and maybe you'll be onto something, but that's not what I asked. I'm not saying that the US economy is on the precipice of anything like what we saw in Japan in the late 1980s. I truly believe the country will continue to thrive and do well, but presumably that's what investors back in Tokyo thought too. General investors lost the shirt off their back because they believed no price was too much to pay for the stock of a Japanese business. My concern regarding the US stock market right now is chiefly around the tech stocks, and I'm feeling an uneasy reminiscence of the playbook we found back in Japan. Just like in Japan, seemingly no price is too much to pay for a technology business, which, let's not forget, makes up over 40% of the entire S&P 500 weightings-wise. If realisation was suddenly to dawn on the great body of investors out there that things around stuff like AI are not going to turn out quite like they'd priced in for, then we have a serious problem on our hands. And this, like the debacle in Japan, a crash in the price of tech stocks might not take a couple of years to straighten out. It could quite plausibly take nearer to quarter of a century price levels to return to how we found them today. The tech boom has been a rising tide that has lifted all boats, but as we know, a falling tide can sink all ships. This is not meant to be a predictor of financial doom or anything else for that matter. It is simply an observation that the value investor would have avoided the fall of the Japanese stock market back then, and they won't be harmed in a fall in technology stocks in the US if that were to happen. US stocks can be bought on many grounds right now, with many differing lines of rationale cited, but what can't or shouldn't be pretended is that one of these grounds is the purchase of stock at less than its book value. You won't be buying much in America right now on value grounds alone. Unlike when your favourite supermarket starts putting up its prices, you can choose to shop elsewhere. Unfortunately, there are plenty of discount alternatives out there. The average price-to-earnings ratio on the S&P 500 index currently sits at around 29 times, way above any other international indices. The FTSE All-Share in London, the CAC in Paris and the DAX in Frankfurt all trade at around 18 times, with the Japanese Nikkei trading at around 15 times earnings. So go ahead and fill your trolleys wisely, folks, and look out for those bog-off opportunities. On that, I shall close this edition. I do hope you've enjoyed it, and looking back at the situation on the Japanese stock market has given some food for thought about when and if a similar situation should unfold in the future. Please do consider adding to playlist and do continue to spread the word. I really do appreciate it. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.